Imagine waking up, turning on the TV, and the first headline you see is Trump imposes new tariffs on China. Sounds like deja vu, right? But it's 2025 and the trade war is back in the spotlight. The reason? Same old accusation. China is manipulating its currency. But what does that even mean? How can a country manipulate its own currency? And more importantly, why would anyone do that on purpose? At first glance, it sounds insane, like a butcher lowering meat prices just to lose money. But in economics, what seems crazy isn't always stupid. Sometimes it's strategy. A weak currency might seem bad, especially for people inside the country watching their paycheck shrink at the supermarket. But from another angle, it can be a secret weapon, a way to boost exports, protect jobs, or even escape massive debt. In this video, we're going to break that puzzle down. You'll understand what devaluation and currency manipulation really mean, why countries do it, how they do it, whether it's fair or cheating, and most importantly, who wins and who foots the bill. Because when it comes to money, the loudest voice isn't always the most honest. And while currency might lose value, learning this is priceless. What is devaluation and currency manipulation? Let's start by clearing up two terms that often get mixed up: devaluation and depreciation. They both involve a currency losing value, but how it happens makes all the difference. Devaluation is when a government chooses to make its currency weaker. It's a deliberate move, like if a central bank announced, "As of today, our currency is worth 10% less against the dollar." It's like someone going to an auction and yelling, "I'm selling my house for half price," but on a national scale and with their own money. Depreciation, on the other hand, happens naturally. It's what occurs when a currency loses value because of market forces, like inflation, political instability, or investor fear. No one pushed a button. It just sank on its own. And then we get to the most controversial term, currency manipulation. There's no clear legal definition, no global rule book that says this is manipulation and this isn't. It's a gray area, but in general, a country is accused of manipulation when it actively interferes with exchange rates, buying or selling foreign currency, printing money, or using reserves, all to make its own currency weaker than it would be naturally. It's kind of like changing the size of the soccer goal in the middle of the match. Technically, you're still playing the same game, but someone's gaining an unfair advantage. The real question is, why would a country want to do that? Why purposely make their own money worth less? The answer lies ahead. Why would a country want a weaker currency? At first glance, it sounds like economic self-harm. Why would anyone choose to make their money weaker? But like many economic strategies, it's not really about helping individuals in the short term. It's about helping the broader economy, especially when it comes to global trade. It all starts with exports. When your currency is weaker, everything your country produces becomes cheaper for foreigners. Imagine selling homemade cookies for $1 each in your country. But because of the exchange rate, they only cost 10 cents to someone in the US. Result, you sell way more. From across the ocean, your products just became irresistible. That boosts factories, creates jobs, and stimulates the economy. At the same time, imports, stuff coming from other countries, get more expensive. That has an interesting side effect. People stop buying foreign goods and switch to local ones. It's like creating an invisible tariff. You don't raise any taxes, but foreign products become more expensive just because your currency is worth less. That protects local industry without violating any trade agreements. Another, less talked about reason is government debt. If a government owes a lot in its own currency, mild inflation, triggered by currency weakening, can make that debt easier to pay. Think about it. If the government borrowed $1 trillion 5 years ago, but that trillion is now worth way less, it doesn't hurt as much to repay it. It's like paying off old loans with new, cheaper money. And finally, there's politics. A government can quietly let its currency weaken to support its industries without causing diplomatic drama. No need for trade wars or public tariffs. Let the exchange rate do the dirty work. But as always, there's a price to pay. Behind the boost for exporters and governments, there's a population watching their wages shrink and prices go up. So how do countries actually weaken their currencies? Let's look at the tools they use. How do countries weaken their currencies? If weakening your currency is so useful, how do countries pull it off? Well, there's no secret button hidden under a central bank desk that says weaken currency. But there are a few reliable tricks that work, and countries use them all the time. First up, lowering interest rates. When a country drops its interest rates, it becomes less attractive to foreign investors. Think of it like a rich tourist looking for a place to park their cash. If your country offers low returns, they'll just go elsewhere. Less money coming in means less demand for your currency, and that drives the value down. Second, printing money, also known as quantitative easing. If a government decides to inject billions into the economy, it puts more money into circulation. This might sound great during a crisis. More cash, more spending, more recovery. But it also waters down the currency. It's like being at a concert and suddenly 500 extra tickets are sold. Your front row seat isn't so special anymore. More currency equals each unit is worth less. Third, playing with foreign reserves. Central banks can buy or sell foreign currencies, like the US dollar, to manipulate the exchange rate. When they flood the market with dollars and buy their own currency, they're trying to push their currency up. But when they do the opposite, dump their own currency and buy foreign money, they're deliberately driving their own value down. Of course, none of this is risk-free. Print too much money and you get runaway inflation. Just ask Venezuela or Zimbabwe. Drop interest rates too low and you scare away investment. Burn through reserves and you're left defenseless in a crisis. Still, countries big and small, rich and poor, keep using these tactics. The problem begins when those tactics are seen as unfair. That's when accusations fly and political tensions explode. Is it fair or is it cheating? When a country weakens its currency, is it playing smart or cheating the global system? That depends on who's telling the story. One of the most heated examples was the clash between the US and China during Trump's presidency. In 2019, the US officially labeled China a currency manipulator, accusing it of devaluing the yuan to boost exports and hurt American industries. But here's the twist. The US itself did the same thing. In 1985, through the famous Plaza Accord, the US got Japan, France, Germany, and the UK to help weaken the US dollar. Why? Because Japan was dominating global trade, and the dollar was too strong. The plan worked too well. Japan's yen skyrocketed, fueling a massive real estate and stock market bubble. When that bubble burst, Japan entered what's now called the lost decades. 30 years of economic stagnation. This is the danger of currency wars. If one country starts, others follow. Everyone tries to devalue their currency to stay competitive, and suddenly the global economy turns into a race to the bottom. Trade becomes chaotic. Trust between nations evaporates. And regular people? They're the ones stuck with inflated prices, lower wages, and fewer choices. So, is it fair? For the country doing it, it's smart economics. For their trading partners, it's manipulation. And usually the people making the rules aren't the ones feeling the pain. Now that we understand the how and the why, there's one big question left. Is a weak currency a good thing or a disaster waiting to happen? Conclusion: is a weak currency good or bad? So, is a weak currency good or bad? The truth is, it depends. It's a double-edged sword. Yes, it can be useful to boost exports, protect local jobs, and ease the burden of government debt. It's like giving the economy a short-term boost, a sugar rush that can help during hard times. But that sugar rush comes with a crash. When a currency weakens, imports get more expensive. From fuel to food to medicine, inflation creeps in. Wages shrink. Inequality grows, it becomes harder for people to afford the basic. And that's just the start. If confidence in the currency erodes, the whole country pays the price. Investors flee, credit dries up, businesses lose stability. No one wants to make long-term plans in a currency they don't trust. Without trust, even the strongest economy gets shaky. So in the end, it's not just about strong or weak currency. It's about who controls the game and who's stuck picking up the pieces. Governments, central banks, big investors, they're moving pieces on the board. But regular people? We're often left watching, wondering why groceries are more expensive and paychecks stretch less. Have you ever felt the effects of currency moves in your daily life? Drop a comment, share this video with someone who's always asking, why is everything so expensive? And remember, a weak currency might be a short-term fix, but the bill always comes due. See you in the next video.